Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula. Registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC.
Hope you're having a great day out there. We appreciate you joining us, spending part of that day here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. Myself, my name is Chris Spawn. 419-794-3030 is the phone number. If you have questions about things we talked about today, or just questions about your retirement in general, want to sit down and speak with the team, 419-794-3030, or the website arhq.com. Today on the show, should you continue investing in a target date fund? We're going to explain why the word annuity isn't really so bad after all, and what kind of inflation fighter can be inserted into a retirement plan. All this and more, but first, got to check in. Nolan, glad to be with you as always. How are you, sir?
Doing wonderful. I just finished up having a nice 4th of July with family and friends. Got to play a little golf and spend some time with the neighbors, and got a couple days to relax. So it was good. I love the weather that we've had. I mean, we've had a little bit of rain, but this time of year is just fantastic when you can leave the windows open and let the breeze kind of blow in when it's not raining. Is a perfect time of year.
It is a great time of year. A lot to be excited for. A lot of great plans going on. My son actually just started swim lessons. He's 8, finally getting around to figure as much as he loves the water, he should learn how to swim. And he's nervous about it because he doesn't think it's going to be easy. And the truth of it is, it's not going to be easy. I told him, it's going to take a little bit of work, but certainly worth doing. And when it comes to retirement planning and getting ready for that great journey that is retirement, truth be told, it isn't easy. But the good news is you've probably done the good bit of the bulk of the work so far, and that is saving money, tucking money away for your retirement, now turning it into a plan. How do you go about doing that? Well, that's what we're here for here on the show, to have that conversation. So again, the number 419-794-3030. The question I want to start with is, how many people have actually saved $1 million for retirement? Well, according to the Federal Reserve, only about 10% have, and that means that 90% they don't have the $1.8 million that BlackRock says you need, or the $3 million that Susie Orman says you need, or the $5 million, we've talked about that before, that Kevin O'Leary talks about. Yet, with all that in mind, a new survey by the Employee Benefit Research Institute, 70% of people still say they're confident they're going to have enough money for retirement. So I have to wonder, how does the team at America's Retirement Headquarters help people become confident about how much money they need in retirement?
I think that overwhelming majority of people we meet with want to gain that confidence about knowing what their retirement looks like, and we absolutely can help them figure out what their number is. And when you look at those numbers in that example, it ranges anywhere from $1 million all the way up to $5 million. And I guess it depends upon where you live, what your lifestyle looks like, what your living expenses look like. I would say a good example of this is somebody that recently came into the office. She's a longtime listener of the radio show and also enjoys our YouTube channel, and came in really kind of wanting to get that question answered. How confident can she be about her retirement? Asking her when she wanted to retire, and really said as soon as possible. And so what we did is we explained to her what is called our Retirement Team Action Plan. So with our Retirement Team Action Plan, to help answer that question for an individual, what we do is we gather a lot of information on our data intake form. That's going to be, your dates of birth. It's going to be your personal savings, maybe investment statements, insurances, things like what your reliable sources of income would be, either a pension or Social Security. And then we do an analysis of their individual situation. And the team stands for taxes, estate planning, asset protection, and money management. As we go through and we're reviewing her individual goals and objectives, we're taking a look at some things. A couple of things jumped out at me, right away in our first meeting. Number one, she was smart enough to pay off her mortgage and her debts. I would say one of the characteristics of somebody confident in retirement time is somebody who doesn't have a big outstanding mortgage or debts that they owe, being debt-free. She also, I think, was really good at diversifying her savings approach. She had some money in FDIC-insured bank CDs. So she had some money that was principally protected, and then she had money in her company-sponsored retirement account that's more in the market for equity-type growth, kind of a blend overall. And so as I go through the retirement team action plan, what we're looking at is we're looking at taxes. What could be the most efficient way to take and distribute those assets? Maybe it's a combination of taking money from some in her retirement accounts, or some of it also in personal savings that she had on the outside. Again, doing, consulting work with either her CPA or utilizing one of our CPAs just to make sure that we cross the T's, dot the I's, and look at the numbers when we run the retirement roadmap for her on taxes. From estate planning, notice that she didn't have an estate plan set up in place. Now, there are a couple of good online services that are pretty economical. For a lot of folks, that things are, pretty straightforward. Some of those more do-it-yourself type services online, I think, can be a great way to do it. Or we also have some recommendations of a couple local attorneys that we work with here. She'd rather, sit down face to face. But in my opinion, no matter how big or small your financial assets are, everybody needs to have an estate plan put in place, dealing with things like, incapacity issues and making sure that your wishes are carried out the way that you want. The asset protection part, is kind of a two-pronged approach in her situation. And that is one, she's going to be transitioning over to Medicare later this year, figuring out, how to enroll in Medicare, and also then determining whether she should get a supplement or take an advantage plan, knowing what her situation is. And the second part of it is, taking a look at, she's not married, has 2 children, but being not married and a single individual here in the state of Ohio in a situation of a nursing home, it's not very friendly what happens in that situation, meaning that, the nursing home is going to want them to spend down their entire life savings before Medicaid would kick in. The good news is she's still fairly young and healthy, and at the age of 64, she has options and choices available on how to protect her assets without buying traditional long-term care. The fourth part of that team action plan is the M, or money management. And when we look at the money management, what we're doing is we're trying to determine, does she have what we consider to be proper portfolio optimization? She's going to be retiring from the healthcare field. So we talked a little bit about, if you think of the last 20 or 30 years in the healthcare industry, the advancements that have been made, similar advancements we've seen in the financial services industry, meaning we can utilize the technology today to put her portfolio in our system to look for portfolio optimization, also to help her understand the level of risk that she's taking. Really happy to see the market's been so cooperative this year. But, when you think of investing buy low, sell high, with the markets at record high, now's a good time where investors really should understand, if and when things get bad, what is the downside risk in the portfolio, and making sure that that risk level lines up with who you are as an investor. If not, you could be the type of investor that, changes courses after the fact, which is a bad strategy to do, of making changes after the market goes down. We put all of those summary of observations, ultimately sharing with her areas that we believe that we can add value to what she's doing. And also we identify any traps or what's called blind spots that maybe she needs to be aware of. Answering the question of how much money do you need, what we have is we have our independent income system calculator. So the independent income system is our unique methodology and philosophy that talks about, how to position those assets to transition into retirement to give you things like reliable income. If you have Social Security as a reliable income source, if you have a pension and maybe there's a gap between what your minimum monthly income needs are, talking about strategies to fund that, looking to have a bucket of money that's designed to give you a pay raise in the future, how to position your equities in the long-term growth bucket of money, having money set aside for rainy days or emergencies that come up along the way. And then once you figure it out, how to put all of your portfolio together in a more efficient manner, protecting those assets, again, from the healthcare planning perspective, and then efficiently planning your estate, is the philosophy behind that. And what we can do is we can take somebody's situation, we can plug all those numbers in our independent income system calculator and give them exactly what that number is. The next thing that we're going to do for her is we're going to help her build out a written retirement income plan. And within the written retirement income plan, what we're going to do is we're going to take all that information and we're going to run an analysis, and we're going to see out of the 2,000 or 3,000 possible scenarios that could happen in retirement time, like, what if the market crashed right when she retired? Or what if healthcare costs go up in the future? Or what if Social Security is not able to provide 100% of the benefits, kind of like what they say? Looking at those scenarios, then we're going to find out how many times it makes it to the end. And that is going to be able to give her that number that makes her confident. If there is maybe some weakness in the plan, maybe it's only, let's say, 75% of the time it makes it to the end zone, then what it does is allows us to go in and start taking a look at why are the reasons the plan doesn't make it to the end. If you know that information, then you can make a more intelligent decision about what type of financial products could be the right investments to add into a portfolio versus just buying an investment based upon past performance. Example there, if a major stock market loss in the early years of retirement would be one of the reasons why it significantly decreases her probability of success, we know there's financial products out there that don't have stock market risk. On the flip end of the scale, sometimes you look at portfolios and they're too conservative. They need to have more growth in the portfolio. Or you could look at things like a longevity list. Her family talked about they have good longevity in her family. And so if her 401k or her company retirement plan, doesn't guarantee income for life, there's other vehicles that provide more reliable income that she could put in the portfolio. And so by taking all of those steps, that I believe she can gain confidence to know she has enough money in for retirement time. So if you're a listener, either on WSPD here, Toledo's largest talk station, or if you're listening on one of our podcasts or even on our YouTube channel, and you're not confident about your plan, we'd be happy if you have more than $250,000 saved up for retirement to help walk you through those tools and resources that we offer here to be able to help you gain confidence. And if the numbers aren't strong enough, then we'll walk you through a game plan on how to increase that confidence. Again, happy to do that. Just give us a call. Tell us you need the Retirement Team Action Plan, and we'll make that happen for you.
If you're interested in finding out more, again, and you've saved $250,000 or more towards your retirement, give a call. Set up a time to speak with the guys. 419-794-3030 is the phone number, or go to the website, and that's arhq.com. The latest numbers show inflation is inching down, but not enough for the Fed to cut interest rates just yet. Still, prices on things like hotel rooms, electronics, cars, appliances, they're slipping. And then, well, there's this.
The price of Costco's $1.50 hot dog soda combination will remain unchanged. Costco's new CEO dispelling rumors during his first earnings call, saying there are no plans to raise that price. The beloved $1.50 hot dog soda combo has cost the same since 1985, and that is welcome news to inflation-weary customers. If Costco's hot dog deal kept pace with the inflation, it would be nearly $4.50.
Thankfully, it has not done that. But that relief aside, inflationary prices, they're proving to be stubborn. Is this something that your clients really complain about, or is it a nothing burger? What big inflation fighter can people insert into their retirement plan?
I think inflation is a real deal. I think it's not only a real deal for people that, like myself, that are out here working with a family, more so even for a retiree that's on more of a fixed income. So it's good to see Costco's hot dog staying the same at $1.50. Mm-hmm. I don't think I've ever had their hot dog though, but their pizza is fantastic, and most of the other things that I get from Costco, I really enjoy. They do a great job, and good to see they're holding prices. When we're looking at it and we're thinking about, what inflation fighters can you put in a retirement plan, there definitely are specific steps and investments that have historically done well throughout an inflationary environment. Number one is if we look at stocks and equities. So historically, stocks have provided strong returns that outpace inflation, really over the long run, whether that's a mix of more domestic or international equities. We've had more relative strength here, I think, in the U.S. for, probably the past 5 or 10 years. But stocks and equities are number one. Number two is looking at real estate. When you look at real estate, not only am I thinking about, say, the price of what your house is, but in a retirement account, you can typically have what is called real estate investment trust. They are called REITs. And, what REITs can do is they can offer rental income and, provide some appreciation to keep pace with and also possibly exceed inflation. In real estate, you normally have two different types of real estate investments or REITs that are out there, what is called private or public REITs. I generally prefer more of the public REITs because of the fact that you have liquidity, meaning that if you wanted to sell that at any given point, since it's publicly traded on an exchange, it makes it fairly liquid. Where the private REITs are going to be less correlated to the overall market day-to-day noise, but tend to be a little bit more illiquid. Next, you have Treasury Inflation-Protected Securities. These are government bonds that are indexed to inflation. They can provide a guaranteed real rate of return, and they adjust the principal value based upon the change in the consumer price index. And that kind of also goes hand in hand with the U.S. government's I-bonds. We had talked about the government's I-bonds over the past couple of years. Those I-bonds hitting a high, I think, of a little over 9% not that long ago. It's still fairly attractive over the 6% range. And again, if we look at where the more recent inflationary numbers are at, those tend to be keeping up also with inflation. Commodities. And so investing in commodities, that's going to be things like gold, silver, other natural resources can act as a hedge against inflation. And, as prices tend to rise, those inflation increases. Or in the other avenue, you could have what is called inflation-protected annuities. So annuities can be a confusing topic, but some annuities offer inflation protection features where the payments increase annually based upon the inflation index. And so it's just a matter of, again, having a good understanding about how the portfolio is constructed, the positive and negative of each of those investment choices, and then figuring out what is the right mix for you. Our software that we have, what we're able to do is we're able to look at portfolio optimization. So in our software, what we can do is we can add in a client's mix of stocks and equities and real estate, Treasury Inflation-Protected Securities, commodities, or indexed inflation annuities, and help them determine what their risk level is, and then show them where their portfolio is optimized. We have investors that maybe are a little bit wary of the stock market right now with an election year. Maybe they want to go and put a bunch of money into things like commodities, gold or silver. And so in the software, we can take and we can make adjustments to the equities and move them over into a different category and show what those outcomes would be. The goal of doing that is to develop that investment policy statement that gives you the ability to understand what the probable outcomes are going to be of your portfolio, 95% of the time, and then show you what your average annual rate of return could be over the long term. And then building out that plan is going to be how you can have inflation fighters to put a strong retirement in place. If you want to know if your investments are keeping up with inflation, or if you want to know maybe what should be added or upgraded in your plan to look at inflation fighters, just give our office a call. We'd be happy to put together an investment policy statement for you, give you a secondary independent portfolio analysis, give you the feedback and show you kind of what your numbers look like. Because in the beginning, as I said, inflation really is the real deal today, whether you're still working or in retirement time. And, in retirement time, if you have more of a fixed income off of your investments, you got to make sure that every dollar is working as hard as possible, and not only keeping up with inflation, but also keeping up with the fact that, if you're pulling money out of a retirement account, taxes in addition to that is another major chomp when it comes to your net bottom number.
Truth be told, inflation has always been a factor in retirement, obviously not as magnified as it has been in the past couple of years, but the buying power of your dollar over the course of 25-year retirement in quote-unquote calmer inflationary times still going to decrease. So you've always needed a factor in there to combat inflation. And the way to go about it, the different strategies, it's going to vary from person to person, really depending on your comfort level and what you want to work with there. But that is what you get with the team at America's Retirement Headquarters, that customized plan that is going to work with you. And so if you have questions about the buying power of your dollar going the distance as time goes on, schedule a time to speak with them, have that conversation, and see what's going to work best for you. 419-794-3030 is how you get started, or you can go to the website, visit them online at arhq.com. Now, picking a financial advisor is a big life decision. After all, research shows that those who work with a financial advisor might end up with about 15% more money to spend in retirement. But what should people try to avoid when it comes to finding that financial advisor?
I think, picking the correct financial advisor can definitely mean all the difference between financial success and financial stress. And so in a couple of different areas that I would give you pointers on is, number one is what you want to do is look at the background, the experience, and the credentials of the professional and or the team that you're working with. A couple of good examples there is next week, my son Andrew is taking his certified financial planner designation. Now, he has a degree in finance and business management from Bowling Green State University with a concentration in financial planning, but the CFP is a professional designation that he'll earn. So I'm extremely excited about, his ability. It takes a couple of months to find out whether, he passes his exam or not, but assuming that he passes it, that's pretty cool to have those initials at the end of the name, showing the demonstration of his commitment to, providing fiduciary work and good financial advice for the people that he services. At the same time, I'd say me being the dad, the old guy, if you will, I think there's a lot to be said about 30 years of experience in the industry. So I've lived through the crash of 2000 and 2008. I've been through COVID. I've seen the experiences of hundreds of families of helping them through that process. So the background, I think, is helpful. Looking at, again, their experiences in life, looking for some of those credentials, professional designations. You want to look at what is their fiduciary duty. Be wary of advisors who are not fiduciaries. Fiduciaries are legally obligated to act in your best interest. Non-fiduciary advisories may recommend products that benefit them more than you. Mm-hmm. I do know there's good salesmen out there. There's good car salesmen out there as well. But you want to be working, if it's your life savings, with somebody who's putting your interests first. Third is looking and evaluating where you could have high fees and costs associated with different investments. Avoid advisors who charge high fees, products that have hidden cost. Understand the fee structure. Whether it's fee only, commission based, or kind of a combination, fee only advisors are typically, considered to be more transparent and less conflict. In working with a fee advisor, they'll typically give you what's called their Form ADV. In the ADV, it will list out any type of conflict. It'll talk about the ways that they get compensated. It's a worthwhile read. And I do think that this topic has become more transparent today than what it has in the past. It's pretty common that somebody will come into the office and they'll ask us, explain to us a little bit of the fee structure. If we're talking about different financial products, they'll want to, have a better understanding as far as what are the internal fees and expenses and the cost of the portfolio. Looking at a comparison that says, how does that fee compare to what else is out in the industry today? Knowing what that is, I think, is good. And if somebody comes into the office and they don't ask us that question, that is one of the things on our retirement team action plan that we go over, because we do want to be transparent about understanding where, there's potential conflicts, the way that our structure of our company works. And that goes back to that transparency. Be cautious of advisors who are not transparent about their compensation, their investment strategies. When you look at the advisor, they should be able to explain to you their investment methodology, so much so that a 10-year-old should be able to repeat what the process is. As an example, in one of our strategies, we look for cash-rich, low debt, high profit margin companies that are needed on a daily basis and or that have a competitive advantage. And that is, again, the philosophy behind that. Understanding those conflicts of interest. So again, if you're working with a fee advisor, their conflicts of interest are typically going to be disclosed in their Form ADV, which is something that they would normally provide for you in that initial consultation. If not, you can just ask for it. A lot of times you're able to get that off their website as well. But knowing what the communication plan is for the advisor, stay clear of advisors who are not, responsive or fail to communicate. They should also have a communication plan that they should be able to describe for you. We do public, private, and social events. Every month we have something that's going on. Making sure that you're getting personalized planning advice, not, cookie cutter off the shelf type of advice that's a one size fits all. Your situation is fairly unique. You want to have that advice. Look at the reviews of the advisor. You can go online, not only Google the company name, read their Google reviews. You can go on websites like Broker Check or SEC Advisor Lookup and get that information. And these are the type of things I think that when you walk through, it's going to help you avoid a financial advisor who maybe doesn't have your best interest at heart. And if you need a second opinion or you want to talk to somebody who's going to take you through that process, again, we're here to help you.
As it turns out, you can actually get to know the team at America's Retirement Headquarters a little better if you go to the website. That is arhq.com. There's an events tab there. Find out more about the events we've got coming up. More chance to sit with them, interact with them. Or if you want to just jump the line and set up a time to speak with them, you can do that as well. Or you can give a call, and that number is 419-794-3030. Now, the Federal Reserve has penciled in one interest rate cut for this year with more projected to follow next year. But this is leaving a lot of people wondering if a cut will happen before the election. Market analyst David Zervos tells CNBC, well, he doesn't think so.
I don't expect there's going to be enough new information before the election to really drive them to do anything significant. Maybe if inflation really were to come down super fast, right, you could maybe argue for something in September. But I think it's easier to just stand pat, watch the data, say we need more information, and then make some decisions once you know whether it's Trump versus Biden in early November. And they'll have 2 meetings this year to go on after they get that information. And the market will probably give them a lot of feedback to think about where financial conditions go after the election.
So with the election looming large, has that made some of your clients anxious, or are they taking things in stride to see how it's going to shake out?
I think after that recent debate, everybody's a little bit anxious this year about the elections. And if they weren't before, I think after that, I look at some of the debates going back in the past with the different presidents, and boy, how things are different. The biggest concern that I have is sometimes people will tell me, well, Nolan, this time it's different. And I hear that, and that's such a dangerous thing to say. And when you're thinking about, how is the election impacting financial plans, long term, this is just one more event and endless events that our country has to go through. And we as a country will get through this. If you go back to listen to previous shows that we did in the past, of course, you can check those out on our YouTube channel, America's Retirement Headquarters, or our Spotify. What we had talked about in the past is election years tend to be strong years within the stock market. And that's exactly what we've seen so far, that we've had, really strong, in specific categories, growth this year in the markets. And so what you don't want to do is you don't want to make a short-term decision about things like the elections that can impact your long-term financial plans. At the same time, if you're anxious about the market, just know there are specific steps that we can take to kind of hedge your bet a little bit and ultimately to protect you. Number one is dependent upon your unique situation. One of the things that you could always do is you could protect some of your profits. Andrew, in his portfolio, he has one of the technology stocks that's been doing great, and it keeps going up and up and up and up and up. It's something that I've talked to him about, and I said, each time it keeps hitting these milestones, that could be a good opportunity for you to go ahead and sell off some of that, build up some of your cash position. So if and when there's a pullback in the market, it allows you to have some buying power. The second thing is there's financial products that are out there that allow you to participate if the market goes up, and they can protect you against some or all of the losses if the market goes down. So if you're anxious about the market, just know that, again, getting a second opinion may allow you to figure out some of the financial tools, products, and strategies that can be able to help you. So here's what I expect between now and the election time. Number one is I expect more market volatility. I don't expect the market to just keep going up. Election years definitely bring up uncertainty. One thing that the stock market doesn't like is uncertainty. If you look at the polls that are out there, and of course you can look at many different polls, depends on what you want to look at. But in general, the polls show both Trump and Biden are kind of neck and neck overall for the presidential spot coming up. So I would expect that uncertainty to create more volatility in the market. How you use that volatility can either create concern for you or it can create an opportunity. I also expect, depending upon how the outcome of the election comes, some tax policy changes. As the law is today, the current tax laws are set to expire, and unless something changes, and again, unless the administration changes, I do believe that there's going to be some tax changes that have to happen. In general, in the long run, I think there's going to be tax changes that have to happen just because of the amount of spending that our government has been doing for the past 10 or 15 years and the massive amount of debt that we have. But I think it's clear, one politician versus the other is going to have a different tax policy change. There was a gentleman in my office that had mentioned, if the one candidate lost, he was going to be very aggressive before the end of this year of paying some taxes and doing a Roth conversion. And number three is you could have a regulatory shift. So elections can lead towards, regulations that can impact different industries, such as healthcare. You could see changes within the energy sector, finances, technology. These changes can be impacted, I think, based upon who the winner is of the election. The economic policies, the new administration or the current administration, may bring changes in fiscal and monetary policy. Example there is they could make changes to what the government spending is, maybe talk a little bit more about the impact of where inflation is going to go, making different decisions on trying to control inflation. I know a lot of that is the Federal Reserve's job, not the president, but those things can be, I think, influenced by what those policies are that put in place. Yeah, you're going to see healthcare policy changes. Scott and Troy have just done a lot of additional work going through, as an example, what some of the changes are for Medicare next year. And there's, some big changes that are coming into the Medicare industry, but there also could be changes for other folks that are on the affordable health care. Social Security and Medicare, both programs are in a financial problem right now. Mm-hmm. Proposals to reform Social Security and Medicare can impact retirement income planning, making sure that you have a backup plan. I think the administrations differ very much so regarding what the trade policy is. The one I think tends to focus more on companies here in the U.S. and bringing jobs and growth back here in the U.S. And the other one is, more focused on the global markets. So again, how you allocate your funds could have a little bit of an impact based upon those trade policies. Consumer confidence, if you look at confidence, I don't know, my unscientific poll of just going on social media, I think a lot of people are frustrated with both sides right now. And, that watching that debate, further brings up the frustration, and that can lower the consumer confidence. And so when you have lower consumer confidence and people tend to back down on spending, those changes in consumer behavior can influence the economic growth and the investment opportunity. So the impact is going to be something that will be historic. But again, there's, always something historic going on in this country.
Sure.
Don't think this time it's different. Have a plan in place. Stick to your long-term plan. If you're anxious, call us. Let's talk and walk through that independent portfolio analysis. We can talk to you about different ways to give you a little bit more peace of mind. So at night you can rest your head and just enjoy the retirement that you've dreamed of.
The one thing that might be different going into this election is we're all closer to retirement, and you might be in that retirement red zone. And so you want to make sure that, whatever may come down the line, it doesn't jeopardize the quality of your retirement. And so that is where having a proper plan in place to know that, guess what? We have one of these every 4 years. If you count the Senate, every 2 years. And so you don't want to have something where you have to head to the hills every 2 years when an election happens. You want to have a plan in place that's going to get you to, through, and beyond. And that is where that independent portfolio analysis, the independent income system, the retirement team action plan all comes into play to hopefully give you a little bit more confidence throughout the years, and you don't have to worry about it come November. So it all starts with a phone call, 419-794-3030. That is the number. Or you can go to the website, find out more about the team, schedule a time to speak with them at arhq.com. If you have a 401k, one of the investment choices you might have is a target date fund. You'd recognize them because there will be a year in the title, 2030, 2035, 2040, etc. The idea is to match the target date fund date with your retirement date, and the fund will slowly move you away from risk. Here's the problem. They don't actually work that well. An article in Barron's focuses on Vanguard and Fidelity in particular, and their quote is, had target date funds never been invented and Vanguard and Fidelity instead placed their 401k shareholders into their existing balanced funds, those investors would be significantly wealthier today. That's a pretty damning statement, I would say. But I have to wonder, Nolan, what is your take on the target date fund?
It kind of reminds me of the rotisserie, that set it and forget it. I know my wife loves to get ours out, once a year when we do usually something around Thanksgiving. And for a lot of people, they have chose to do this set it and forget it type route. In fact, a lot of times when a 401k changes from one company to another, the default is ultimately to put those investments into some type of target date investment. My thought process is this, as you get closer to retirement time, so when you're within 5 or 10 years of retirement time, I don't know that a target date fund is necessarily what I would think is the best approach for most of the retirees that we work with. And let me give you an example. I met with somebody here recently. We'll call her Nikki. Nikki had amassed a nice amount of money in her 401k in the target date retirement account. She's looking to retire within the next 5 years. And so what happens in these target date funds is they will allocate more money towards fixed income, aka like bonds and cash, as they get closer to that retirement date. Well, if we go back and we look at the last couple of years, most of those fixed income bond type of investments really struggled because of the interest rate risk that was out there. So a large portion of the portfolio that was shifted over into fixed income that was perceived to be somewhat of a safer type of an investment was actually an investment that, physically, in many cases, the value went down on the statement. In addition to that, the double whammy of that is it didn't keep up with inflation, so you lost purchasing power. And then the triple whammy of that is the fact that it's a retirement account, so taxes haven't been paid on that money. And so it's almost a trifecta of bad things that happened with the target date funds over the last couple of years. In fact, the most recent check here at the beginning of July, the aggregate bond index is still either slightly negative or flat year to date. Again, that investor in the target date fund with a large percentage is continuing to lose purchasing power. So the problem here is you ultimately end up with a one size fits all versus a customized approach. What happened with her is because of the fact that she's over the age 59 and a half, her 401k gives her the ability where she can do an age-based in-service transfer. So in my opinion, if we look at where fixed rates are today, to me, there's much more attractive investment options that can eliminate the cost and the risk associated with the fixed income part of our portfolio. I mean, even a money market account today is still earning over 5%. You could put money into an FDIC insured bank CD, and these rates are extremely attractive on where CD rates are at. If she wanted the peace of mind to have that FDIC insured CD, you can get what is called a multi-year guaranteed annuity, where you can go to the insurance companies of America and you can lock in these decade-level high interest rates for quite some time. Or even for a risk reduction strategy, money can be positioned into what is called an indexed annuity that would allow an investor to participate in part of the gains of the market going up, but add in some principal guarantee. So that allows a little bit more of a customized approach. On her equity side, most 401ks offer, 10, 15, 20 different investment choices. Half of those are usually those target date funds. So when you narrow it down, usually in a 401k, you have limited choices. But again, using that age-based in-service strategy allows somebody to have a completely customized approach of how to build out the overall portfolio. The other issue with a target date fund is the asset allocation shifts are really not flexible. It's going to target that date of when retirement is. So if the target date's 2025, it's assuming the person in that investment is going to retire around 2025. And so it's going to make those changes. And what it's not going to do is it's not going to typically adapt to the current market conditions, meaning that the fixed income versus equities are not going to take into consideration, where we're at in the economic cycle. They're just going to stick to what their mandate is. I think that utilizing a more customized approach and or looking at the investment choices that are available is a much better solution. What we have is we have a technology platform that we put together, and what we can do is do a couple different things. Number one is we can take a look at the investment choices that you have within inside of your plan, and we can tell you what we believe to be some of the best choices based upon your individual goals and objectives. We can give you advice on what's called strategic asset allocation, investing in large, medium, small, international, and also we can give you the ability to add in like a circuit breaker on your 401k. So if and when the market has a technical breakdown, we can email or push notification alert you to take defensive measures to protect your portfolio. And while the market is at a record high, now's the time to be thinking about adding in downside protection into the plan. The software that we use, you can check it out. It's planconfidence.com, or better yet, if you want that specific advice on your 401k, all we have to do is get a copy of the investment statement, and we can do that analysis and give you feedback. So if you're in a target date fund, or even if you have like a variable annuity and you're in a target date variable annuity, you could be stuck in a mediocre approach, where, in my opinion, that customized approach can be much more tailored to your individual likes, goals, and objectives.
Any money saved towards retirement is better than nothing, but you don't want a better than nothing retirement. You want a retirement that is going to work for you. You want that money to work as hard for you as possible as you've worked for it. And so that is where we're looking at other investment strategies, perhaps shifting that money out, especially if you can do that rollover really comes into play. To see what can be done and how to go about doing it, schedule a time to speak with the team at America's Retirement Headquarters. 419-794-3030 is the number. You can also go to the website, arhq.com. Do you remember when paying for something with cash was the best way to avoid transaction fees? That's not really the case anymore. A lot of stadiums and restaurants, they say they're no longer accepting cash, and they actually point you to get this a reverse ATM that turns your cash into a debit card for, well, you got it, a fee. You want to pay parking tickets, tolls, taxes, or phone bill with cash, might be a fee for that as well. The bottom line is your cash is reduced, just like hidden fees in 401ks and IRAs that can eat into your returns. Nolan, what are some of the surprise fees that people might find or might not even know exist in their retirement accounts?
It is. It's, I think, very important to make sure that you have a very clear understanding of what the fees and expenses are. I go back, in the fact that I got in the industry a little over 30 years ago. 30 years ago, what I had to do is I'd have to read through like a 400-page prospectus and go to different sections, determining what the fees and expenses are today. I think the one thing that's good about today's times is, things have become more transparent today, as well as the fact that I think that the industry shift across the board has been to reduce fees and expenses. But still, all the time, I have people come to the office, and I'm surprised at some of the fees and expenses that they have. And sometimes surprises are good, maybe if it's for your birthday, and other times, like, all these hidden fees are not good surprises to find out about. But it's important that you know what that is, because in absence of value, if a fee can be eliminated, that ultimately can be put right back into the investor's bottom line in their pocket. So the fees and expenses that you want to take note of and look at what's out inside of there is, number one, is what your expense ratios. So when you're looking at expense ratios, what you're looking at is you're looking at the cost of the underlying investment to determine what those total fees and expenses are. And a good website to do that is Morningstar.com. So with Morningstar.com, what you can do is you can go over there and you can type in the name of the investment that you have. You just type in the symbol, and it will show you ultimately some of the fees and expenses that are part of the plan. So Morningstar.com is a good website when you look at expense ratios. That's a free website that you can take advantage of. The second thing that you want to do is you want to look at what the trading fees and expenses are. Trading fees are related to the cost of, buying, selling your investments. Some firms have trading costs and other ones don't. I know I personally work with Charles Schwab on my own accounts as well as most of our client accounts. And, one of the things that I like about Charles Schwab is when you trade stocks, equities, and a laundry list of mutual funds that are covered. There's no trading fees and expenses in some of their plans that they have. So trading costs have come down quite a bit, but there are definitely still brokers out there that charge trading fees. Number 3 is when you're looking at what is called upfront or back-end loads. Those are usually related to when you're in the mutual fund industry, what share class you're in. So like a Class A mutual fund could have an upfront sales charge. A Class B mutual fund could have a back-end sales charge. Those are often called loads within the investments. Sometimes loads make sense. I mean, if you're going to own an investment and hold on to it for an indefinite period of time, it may be more cost effective up front to just, pay for what that load or that expense is if they don't have an institutional share class, or if you don't meet the minimum of that institutional share class. That could ultimately in the long run be more cost effective than paying, say, a management fee. Number 4 is surrender charges. Some products traditionally have surrender charges associated with them. And a lot of times it can be either if you buy a bank CD and you bought a 3-year bank CD, if you cashed in the CD early, you want to know what the terms of the surrender charge would be on the CD. Is it 1 month penalty? Is it 6 months penalty? If you purchase an annuity from an insurance contract, if it's a 3, 5, 7, or 10-year contract, if you decide to get out of that contract early, understanding what those surrender charges are, how they apply to your situation. So the keys to knowing these areas when you look at, again, some of the surprise fees that are out there is read the fine print. A lot of this information is ultimately in those prospectuses. Again, there's some websites that I gave you there that you can get that information. But go through, read the fine print, make sure that you understand what that is. Compare cost. When you look at investments, there's a lot of investments that have similar philosophies and methodologies, and so they work a little bit different. And as they work a little bit different, if you can get something that has the similar or potentially better results than what you have today and do it in a more cost-effective manner, that can be a great win for you when you compare cost. Number 3 is ask questions. It's okay to ask questions. And again, ask them, what is the expense ratio? What are the trading fees? Are there any upfront or back-end loads? Are there any sales charges? Or what other costs should I be aware of so I'm not surprised by any fees that are out there? And just feel free to ask those questions. And then you want to monitor your accounts. Sometimes hidden fees will sneak in over time. Sometimes you'll notice fees and expenses on your portfolio that you were not aware of. And then, the bottom line at the end of the day, too, is you can also get a second opinion. So if you're looking at your account and you don't know down to the penny what your fees and expenses are, number 1, call the investment company that you're working with and ask them that question. Or number 2, get a second opinion. If we get a copy of your investment statement, we'd be happy to kind of run it through that for you and break down where the fees and expenses are. I know, one of my favorite things to do is put a pair of golf pants on that I haven't had on since last summer, and I find $20 that I left in my golf pants from last year. So we love doing that for people. We love finding, money that's set aside that they didn't know that they had available by eliminating some of those wasted fees and expenses that they have in their portfolio. So we would be more than happy to walk you through an independent portfolio analysis, provide you a printout, a summary. If you would like that information, all you have to do is reach out to the office. We can walk you through that and get you that independent portfolio analysis, and happy to help try to make sure that your money is working as hard as you have been.
It's not to say that all fees are bad out there. Ideally, you should be getting something of value, of comparable value for what you are paying. But we know that's not always the case. And especially if they're hidden, it's really difficult to assess the value that you're getting for what you don't know that you're paying. This is where that independent portfolio analysis comes into play. And if you find out that, it isn't actually worth it, being able to look at maybe other ways to put your money, other ways to invest, it's all part of that retirement team action plan. It is what the team at America's Retirement Headquarters does for you. And you can get started by giving a call, reaching out to them, 419-794-3030. Once again, that's 419-794-3030. You can always find them online as well, and that is arhq.com. I want to thank you for joining us, as we always do, here on America's Retirement Headquarters, the home of the Retirement Guys formula and America's Medicare Associates. Really do appreciate it. You have a great week ahead of you. Hope you stay safe out there. Nolan, always grateful for the time. And as we wrap up, I want to leave you with the final word.
Yeah, great quote for the week. It's retire from work, but not from life. Enjoy the beautiful weather that we're having out there and enjoy this summer. And we look forward to seeing everybody here next week.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.